Silver is going to vastly outperform gold. In the case of silver, they don't just go to what might be a fair value in terms of converting versus M2, for example. What's the money growth been since 1980? Well, if silver merely matched that, it would be here. If it matched copper, it would be here. And all those numbers come up to like $500, okay? But quite often, markets will overshoot that. And so we have ceased to come up with an opinion about where silver's headed, except to say we would not at all be surprised to see 500 and even a lot higher, and very quickly, a lot of that very quickly, catching up to gold. And during the time silver is catching up, gold's also going to be advancing.
Silver is coiling for one of the most explosive repricing events in modern financial history after spending nearly half a century trapped in a compressed trading range. A compounding 6-year structural deficit in industrial supply has left physical inventories completely depleted while demand accelerates across the globe. Michaeloliver, a veteran momentum technician and chief market strategist at Momentum Structural Analysis, highlights that precious metals have officially entered the initial phase of a multi-year supercycle. When financial markets finally resolve prolonged pricing distortions, capital momentum routinely overshoots fundamental fair value. Silver is projected to surge rapidly toward the $500 per ounce mark simply to align with historical M2 money supply expansion and track the multi-fold gains recorded by base metals like copper since 1980. However, the actual upside is anticipated to reach significantly higher levels in a rapid catch-up phase, as silver currently trades at a mere fraction of gold's valuation compared to its historical peaks. This massive structural mispricing positions silver to vastly outgain gold and deliver extraordinary outperformance across the broader commodity sector. Now, we present the clips from Michaeloliver's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
Silver is going to vastly outperform gold. Think about this. While those miners are dropped down to XAU went from 27% average to 4%, okay? And now they're over 9%, by the way. Silver back in 1980, when it was $50, 6.5% of an ounce of gold at its valuation. In 2011, when it came back to 50 again, it was 3.1%. Right now, silver is only 1.6% of the price of gold. So it's vastly undervalued as well, but its technicals, just like the spread we looked at, if we did silver versus gold, it's also broken out. That occurred last November. So anyway, that I think we're on the edge of the real explosion. And then what we saw late last year was merely sort of an upside exhale after silver, for example, had been confined in a box for half a century. And we make this, there's all kinds of arguments for this, not just our technicals. But if you look at the price of copper, you go back to 1980, or lead, or zinc, or aluminum, or steel, go back to 1980. Do you know where they're trading right now relative to that price level? Between about 4 to 6 times. So, okay, copper was averaged about $1 back in the 1980s. You could see down there, even then, up through 2005. In 2005, it broke out above those highs, which is like $1.
That was a new normal.
About $1.50. But the average price was about $1 during the 1980s, 90s through 2005, right about there. And you're trading $6.70. If silver were doing what copper's doing, you know, you can do the math. Gold is right now more than 4.5 times higher than where it was in 1980. And silver's what? All of $20 above 1980? Small singles, a couple digit percent. What's going on there? We have a supply-demand deficit in silver. We know that industrial output, industrial demand is not being met for 6 years now. And yet it's not matching copper, lead, zinc, or gold. Something's wrong there. So we argue that when an error has been made, whether it was coerced or the investors made an error, or a combination there of both, when markets correct for errors, they often overshoot reality, which they not only make up for being underpriced too long or overpriced too long and have a deeper bear market. In the case of silver, they don't just go to what might be a fair value in terms of converting versus M2, for example. What's the money growth been since 1980? Well, if silver merely matched that, it would be here. If it matched copper, it would be here. And all those numbers come up to like $500, okay? But quite often, markets will overshoot that. And so we have ceased to come up with an opinion about where silver's headed, except to say we would not at all be surprised to see 500 and even a lot higher, and very quickly, a lot of that very quickly, catching up to gold. And during the time silver is catching up, gold's also going to be advancing. So anyway, that's where I think we are right now at this point in history. I think the S&P, when you go back to 2000, for example, when gold was a couple $100, gold has vastly outpaced money supply. S&P has basically matched the money growth, meaning it's not done much better than the growth in the money supply, meaning you've really not made money. You've made nominal money. But when you convert that money to buy products, groceries, gasoline, build a new home. I've used this before, but your granddad built a house that was $4,500. Your father, $45,000. The median home today is $450,000. What does that say? Okay. The degradation in the money unit. And it's not just US, it's Japan as we know it, Europe, UK. It's a global crisis among major powers. That's all gold is reflecting. It's not reflecting global uncertainty about the Iran war. That's baloney. Wars don't drive gold. They never have. It's not nervous about what is the Fed going to do on the short end of the market. That historically does not correlate whatsoever to what gold does. I mean, if you think higher rates will hurt gold, go back and look at the late 1970s. When gold went to $850 by 1980, from a low at 103 in 1976. The Fed was raising rates like crazy, and even long-term bond yields were rising sharply, and yet gold exploded. So these correlations don't work. What it is the ongoing degradation in the money units, ours, Japan, Europe, etc. So that's where we are, and that's what gold knows. And I think we're in a crisis now because the monetary expansion and the panic by the central banks, not just Japan, which they've been panicked. They've been printing, to quote the prime minister of Japan. But our money growth is aggressively growing again. All of a sudden now we have a debt crisis that not only is the Fed going to have to face, even though it's not one of their mandates, they can't let the house burn down, and the Treasury has to issue panic statements, but with a smile, so nobody gets nervous. Gold knows that.
Yeah.
That's where we are.
Gold's sustained advance directly mirrors the systemic erosion of unbacked fiat currencies across every major industrialized economy. While benchmark stock indexes have nominally tracked money supply growth since 2000, investors have accumulated nominal gains without expanding real purchasing power against tangible living expenses. A typical family home that cost $4,500 2 generations ago and $45,000 a generation later now commands a median valuation of $450,000, exposing continuous structural currency destruction across the United States, Europe, the United Kingdom, and Japan. Mainstream narratives claiming interest rate increases will suppress precious metals are historically flawed. During the late 1970s, gold rocketed from just over $100 to $850 even as central banks raised borrowing costs aggressively. Central banks are once again accelerating monetary printing to manage mounting deficits. Ensuring tangible monetary assets remain the ultimate store of real value. Now let's get back to the interview.
The dollar index, you get the context here. Everybody thinks, well, dollar goes down, that's good for gold. Well, it's baloney. Sometimes it is, sometimes it doesn't matter. If you go back to when gold bottomed in 2015 at a price of 150, December 2015, and go back and look where the dollar index was then, and circle that price, it was around 97, 98, and draw a line through the past 11 years of dollar index action. We're there now at the same price the dollar index was 11 years ago. It's been up and down below that level, but it's where it was then, okay? And so you would say, well, looking at the dollar index, it's sideways for 11 years, therefore gold must be sideways, right? No, gold's 4.5 times where it was then, okay? So the correlation's pretty pathetic. But if you just punch up a dollar index price chart, and
yeah, so here it is in white.
Yeah, just that alone. Eliminate the other chart, whatever that is.
Oh, okay.
Okay, dollar index. Now you got gold, I think. Okay, there you go. Now, beautiful. We draw a line going back to 2008 even. I think you can go back further if you can. Yeah, there's a low there. That's when it made a low down around 70. Okay, but if you draw a line under the low, for example, in 2010, 11, and go up through the other lows, like the line you've gotten right there, draw that line. You'll notice that we dropped from a high at about 110 area back early in 2025. Go further over to the right. There was a high at 115 back in 2023. Okay. Then go to the right. There's a secondary high that occurred later. Yeah, that one there. Okay. That was in early 2025. When we slipped off that high and got down to about 104.21, the close in March, that first big bad red bar you're looking at right there. Yeah. We said, that's it, bear market coming in the dollar index. Not because of the price chart, because the price chart had an idiot line that any idiot could draw, as we just did. Okay. You don't have to be a genius. But annual momentum of the dollar index broke that structure big time. And then has rallied up under it, whereas the price of the dollar index hit that line that goes back decades and lived on it for like a year. It didn't hot-foot it off that line. It lived on it. It groped along the line, sick, anemic. And then a couple of months ago, you had this marginal little green bar that broke up out of that little tight range. That was a bull trap. We said it was. So in other words, you had a breakout in price, and everybody said, oh, the dollar's strong. It aborted, and now you're back down inside that range. Again, annual momentum said sell this a year and a half ago at 104. Right now you're trading at 98 and change. We're arguing what's going to happen next is price will catch up to momentum and break its line, meaning if that action we're seeing the last month or two, the downside, you get back down to around 97 and a half, which is to say a point and a half below where you are now. Recent lows have been 98 and a half. The price guys are going to give up too. They're going to say, oops, we were wrong. That's when you're going to get your downside payoff. And suddenly this global pricing factor, the relative value of the dollar versus the euro and the yen, because that's really what this is. 70% of this is euro and yen combined. So it's really not a broad index of the dollar index. When you get down to about 97 and a half, this thing's going to start to puke. And that only requires like a point or so below where you're trading right now. And when that happens, then suddenly the dollar is going to be a factor in markets around the world, the dollar index, that is. All this is a measurement of the relative value of pieces of paper, okay, none of which are backed by anything but government promises and more paper, okay? So it's really a silly notion to have because this doesn't tell you what the dollar is really worth in terms of real terms. Look at an M2 chart, turn it upside down, and that's when you'll see what the dollar's worth in real terms. Yeah, there you go. Yeah, M2 upside down. Anyway, it's been appreciating nicely, right? The quantification.
Zero.
Okay, yeah, right. Anyway, the paper crisis is about to hit, and the government bond crisis, Japan, now us, is bringing that to the fore. It's been there for years. But as Jamie Dimon noted, half a year ago, I think, or 4 or 5 months ago, we got a government bond crisis. We're going to have to face it. And he didn't mean 10 years from now. He meant now. And he's right. And this is a nuclear event. And it's going to reshape all of our thoughts about, this asset or that asset. And gold knows it.
Technical dynamics in the currency markets reveal that the U.S. dollar index is breaking down beneath the surface. Annual momentum indicators severed critical multi-decade baseline support long before nominal spot prices started slipping, exposing recent dollar rallies as classic bull traps. Because 70% of the index is weighted purely against the euro and Japanese yen, it merely compares unbacked paper notes against one another, rather than assessing real intrinsic value. A closer inspection of inverted broad money supply charts shows paper purchasing power sliding toward zero. As spot pricing slides below key support thresholds near 97.5, conventional technical traders will be forced to abandon long dollar positions, accelerating a sharp downside cascade. This currency deterioration coincides with an accelerating government bond crisis that will fundamentally disrupt global debt markets and ignite massive capital preservation flows into physical gold and silver. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.